All right, let's jump right in. Today, we're going to cut through all the noise and talk about a really big investment choice: pure equity funds versus hybrid funds. I promise by the end of this, you'll have a much clearer idea of which one is right for you. If you've ever felt kind of stuck between these two, you are definitely not alone. It's a super common question, but honestly, picking the right one is one of the most important moves you can make for your financial future.
So, our goal here is pretty simple. We're going to give you a straightforward way to think about this decision. Really, it all boils down to three key things: your age, what your goals are, and how comfortable you are with a little bit of risk.
And to make this really, really clear, let's use a simple analogy. Just imagine your entire investment portfolio is a car, right? You've got an accelerator to make it go faster, and you've got a brake to keep things under control. Okay, so a pure equity funds, that's your accelerator. It's built for high growth, for really pushing your wealth forward over time. But what's the catch? Well, just like flooring it in a car, you're gonna feel more bumps in the road. And in investing, we call those bumps higher volatility. Now, a hybrid fund, that's your brake. And it's also your balance. See, it mixes stocks with more stable stuff like bonds. So what you get is moderate growth, but with a much, much smoother ride. It gives you more control, which means lower volatility.
All right, so the car analogy is pretty helpful, right? But let's get into the hard numbers. This is where you can really see the difference between hitting the gas and tapping the brakes.
This table lays it all out pretty clearly. You can see the trade-off right there. Pure equity is aiming for those higher returns. We're talking 11 to 14%, but it comes with higher risk and more volatility. The biggest takeaway here, though, is the time horizon. Look at that. Equity is a long-haul game. Think 5 years or more. Hybrids, they're built for those shorter time frames, maybe 3 to 5 years, where you need a bit more stability. So, how do you actually use this info? Well, the best way is to tailor your strategy to where you are in life. Your age is actually one of the best guides for figuring out how much accelerator versus how much brake you should be using. Okay, if you're in your 20s or even your early 30s, you have this incredible advantage called time. And that means you can lean really heavily on that accelerator. An 85% allocation to equity makes a ton of sense here, because you literally have decades to recover from any market dips and just maximize that growth potential. Now, when you get into your 30s and 40s, life usually gets a bit more complex, right? Maybe there's a mortgage, a family, and your portfolio needs to reflect that. This is where you start to gently apply the brake, shifting to a more balanced mix, something like 65% equity, 35% hybrid. As you move into your 40s and 50s, the priority really starts to shift. It's less about aggressive growth and more about protecting the wealth you've worked so hard to build. So the allocation actually flips. You see the majority of your portfolio, 55%, is now in those more stable hybrid funds to really dial down the overall risk. And finally, for anyone over 50, especially as you're getting closer to retirement, well, stability is king. The main goal now is protecting your capital and maybe generating some steady income. So the portfolio is heavily weighted toward hybrid funds, like 75%, using that accelerator very sparingly, really just enough to stay ahead of inflation. Seeing this progression helps us understand some of the most common mistakes people make. Some folks go 100% on the accelerator and don't fully grasp the risk. Others are too scared, avoid it completely, and then they miss out on all that potential. But you know what? Maybe the biggest mistake is that third one on the list: not adjusting your allocation as you get older. Your strategy absolutely has to evolve as your life does. So, after all of that, what's the one key thing I want you to walk away with? If you just remember one thing from our conversation, please make it this. It's that your allocation has to evolve with your life. It's that simple. What works for you in your 20s is not what you need in your 50s. Smart investing is not a set it and forget it kind of deal. It's a dynamic process. Your mix of accelerators and brake has to change as your life changes. So I'll just leave you with this one question to think about. Is your portfolio actually keeping pace with your life right now? Or is it maybe stuck reflecting a past version of you? Maybe it's time for a little tune-up. Now, just a reminder, this conversation is for educational purposes only. Mutual fund investments are subject to market risks, so please be sure to consult a qualified professional before investing.